This segment sponsored by Foster Financial. Welcome to Money Monday, where we give you holistic financial advice from Foster Financial. And joining me is their Vice President, Caleb Doane. Good morning.
Good morning.
How's it going?
It's going well. How are you?
Good. Okay, so every time you come in, we talk about something interesting that's happening. And right now, things are going kind of crazy in the market. So what are we going to talk about today?
Yeah, so today we're going to talk a little bit about some of the market volatility that we've seen over the last week. Last Monday, I think it was, the NASDAQ opened like 6% down at some point throughout the day. It made up some of that towards the end of the day, but investors a lot of times are asking, hey, what can we do to maybe reduce risk in our portfolio? So that's what I figured we'd talk about today.
So why do you feel that it's been so volatile lately? Like, what is the reason that this market has spiked in, or rather dropped in the recent week?
Yeah, so there's just so much information that's coming out all at once. So, I mean, the Fed is kind of releasing information on what they're going to do with interest rates. Jobs data is coming out. Corporate profits are coming out. And it just so happened last Monday, a lot of that stuff happened to be negative. And so the market opened, pretty low, the lowest it has in a long time. And, of course, it made up some of that. But, again, it just gets people thinking about, hey, what should I be doing in my portfolio? One of the things that's really important to take a look at, and what we've done for our clients several times so far this year, is rebalancing their accounts. So sometimes people have a target allocation, maybe they want to be 70% kind of equities, which is more growth oriented. Maybe they want to be 30% bonds, which is more conservative. Well, over the last year and a half with markets going up, of course, the growth side of their portfolio is going up the most. And so they were at 70-30, now maybe they're at 80-20 because the markets have gone up so much. And so what we've done several times throughout the year in all of the qualified accounts that we manage is rebalance them. So we harvest gain on that growth side, reinvest it across the other pieces of their portfolio, so it brings risk down and puts them back in the tolerance that they need to be in.
Okay, and so that's advice as far as what you would kind of do, but how should the investors respond now? So should they take action now? Should they wait, come see you? Should they come see you now?
Yeah, especially if somebody's really anxious about, let's say, their 401k that they manage themselves. A lot of times 401ks probably don't get the attention that maybe they deserve because people are focused on working, right? I mean, they're in their working years. Managing your assets can very easily be a full-time job or at least a part-time job. And usually it's something that people kind of have set on autopilot. So it's not time to panic. Of course, it's time to kind of make a plan. And part of making a plan could be looking at ways to reduce risk in the portfolio. One of the ways that we've done that for a lot of clients, if they have 401ks, we can roll them over into an IRA a lot of times. A lot of times people are eligible to do that, especially as they get close to retirement, even if they're still working, and especially if they're over 59 and a half, that's usually an option. And one of the things that we've been adding to the portfolios is what's called buffered funds. And we've talked about these a little bit before, but a lot of times people's default when they see a lot of the fluctuations in the market, they want to get out of the market. They're like, hey, I want to go to cash. I don't want to kind of ride this roller coaster anymore. And sometimes that oftentimes, I guess, is probably not the best idea because then you're timing the market on when to get back in. Buffered funds are a great way that we've used inside IRAs to be able to manage some of that risk. It has some downside protection, so it's like a 10% buffer. If the S&P goes down 10%, these funds don't go down anything. If the S&P goes down 15, these funds will go down 5. So it kind of avoids that first 10% on the downside, and then it's capped on the upside at 17%, let's say. So if the market goes up 17, you go up 17. If the S&P goes up 20, you only go up 17. So that's been a good alternative to give people some protection on the downside, but still be able to participate in that upside.
Okay, wow, that's good stuff. I mean, so basically the biggest takeaway is do not panic. And of course the markets, they go up and they go down. And so I know that you all really focused and you monitor what the trends are and what the patterns have been, and especially like we talked about the last time, this is election year. So things are happening, the markets are moving, companies are, getting a little scared, they're getting a little confident. So we'll just see how it plays out.
Yeah, absolutely.
Well, thank you so much for coming in with this information today.
Yeah, thank you.
And if you all would like more information about Foster Financial, we'll have their phone number listed below to give them a call. And I'll see you after the break. This segment sponsored by Foster Financial.